The Federal Reserve just made a decision that affects every dollar you earn, save, and invest, and most people have no idea what it actually means for their money. In March 2026, the Fed voted 11-1 to hold interest rates steady for the second time in a row. No cut, no hike, just a hold. But here's the thing. A hold is not neutral. It sends a message. And that message has real consequences for your portfolio, your savings account, and your borrowing costs. Here's what you need to understand. The federal funds rate, currently sitting at 3.50% to 3.75%, is the rate banks charge each other for overnight loans. But it ripples through the entire economy. It influences mortgage rates, credit card APRs, auto loans, savings account yields, and even how stocks are priced. When the Fed holds rates steady, it means the cost of borrowing stays elevated, and the reward for saving stays attractive. But it also signals that the Fed isn't confident enough in the economy to start cutting. This video is for educational and informational purposes only, and does not constitute financial, investment, or tax advice. Always consult a qualified financial advisor before making any investment decisions. Past performance does not guarantee future results. The FOMC held rates at 3.50 to 3.75% on March 18, 2026. The vote was 11-1. Only Governor Moran dissented, pushing for a 25 basis point cut. The committee cited increased uncertainty in the economic outlook, pointing specifically to developments in the Middle East and rising energy prices. This is the second consecutive meeting with no change, and markets had already priced this in. The CME FedWatch tool showed near zero probability of a cut going into the meeting. But what caught attention was the updated dot plot. The closely watched dot plot, where each FOMC member projects where rates should be, now points to just one rate cut in all of 2026. 7 of the 19 participants see no cuts at all this year. On top of that, the Fed raised its inflation projection. The preferred gauge, the PCE price index, is now expected to hit 2.7% by year-end, up from the 2.5% forecast issued in December. That's moving in the wrong direction for anyone hoping for aggressive rate cuts. The takeaway, the higher-for-longer narrative is very much alive. According to FOMC projections, rates may not move meaningfully lower until 2027. The S&P 500 is down roughly 4 to 6.7% year-to-date in 2026, according to market data through early April. That's a sharp reversal from 2025, when the index returned 18% total. Rate holds create a tug-of-war for stocks. On one hand, no further tightening is welcome. On the other, stocks don't get the earnings boost that comes with lower borrowing costs. Add in geopolitical uncertainty from the US-Iran conflict and surging oil prices, and the result is the kind of volatility that tests investor patience. Historically, flat-rate environments haven't been catastrophic for stocks, but they tend to produce more modest, uneven returns. The practical move: stay invested, stay diversified, and avoid the temptation to time rate cuts that may or may not come. Here's the silver lining for anyone holding cash. As of April 2026, the best high-yield savings accounts are still paying up to 5% APY. Most accounts sit around 4%. That's roughly 10 times the national average of 0.39%. This is a direct consequence of rates staying elevated. For investors with cash on the sidelines, whether in an emergency fund or waiting for a better entry point into the market, these yields represent historically attractive, risk-free returns. But this window has a shelf life. When rate cuts eventually arrive, HYSA yields will follow within weeks. According to Bankrate, top savings rates have already drifted down from the 5.5% peaks seen in late 2024. The flip side of attractive savings rates is painful borrowing costs. The average 30-year fixed mortgage rate was 6.37% as of April 9, 2026, according to Freddie Mac. That's down slightly from 6.46% the week before, but still well above the sub-4% rates many homeowners locked in during 2020 and 2021. To put that in perspective, on a $400,000 mortgage, the difference between a 4.5% rate and a 6.37% rate adds roughly $580 per month to your payment. Credit cards, auto loans, and HEE locks are all similarly elevated. For investors considering leveraged strategies or real estate investments, the math has to account for this cost of capital, and that changes the calculus significantly. So where does this leave investors heading into the rest of 2026? 3 things to watch closely. First, the next FOMC meeting on April 28th and 29th. Markets expect another hold, but the statement language will matter, especially any signals about the second half of the year. Second, the Fed chair transition. Jerome Powell's term expires May 15, 2026. Nominee Kevin Warsh is expected to take over. A new chair could shift the tone and pace of monetary policy. Third, inflation data. If PCE continues tracking above 2.5%, the case for even one cut in 2026 weakens further. The bottom line, this is not a time for dramatic moves. It's a time for discipline, staying invested, keeping savings in high-yield accounts, and avoiding the temptation to time rate cuts that may or may not come. If this breakdown helped clarify what the Fed's decision means for your money, subscribe. New videos every week breaking down the market in plain language. And drop a question in the comments. Are you positioning for rate cuts in 2026 or staying the course?